get started. So, hello, everyone. Thank you so much for joining us on part four of our six-part series where we get to talk to the brilliance of the mortgage minds. I got Megan Wendell and Diana Lee, two of the absolute best, joining us, Maxwell Devonshire Realty, for our Mortgage Minute with the Mortgage Minds. Now, I'm broker of Maxwell Devonshire Realty, but these are really the ones that you want to be talking to or listening to. So I'm going to get out of your way and let the pros talk to you. Floor is yours.
Thanks so much for having us, Alex. My name's Megan Wendell. I am a mortgage broker with the Mortgage Minds. Our wonderful team is comprised of some amazing brokers who have been in the industry long term, and we're combined over 130 years experience. So we're here to help you in your home buying journey, whether it is you personally or your clients, and help guide and provide as much education as we possibly can along the way. Diana?
Yeah, thanks. Thanks for having us, everyone. Glad to be back. I'm Diana Lee, and definitely proud team member of this group, the Mortgage Minds. We are kind of spread all over the city and throughout, certain parts of the province too. So we're really, really lucky to have that community. And I've been doing this for, gosh, I think we're hitting up 20 years now. So time is going by very quickly when you're having fun, they say, right? So thanks for having us. We're really excited to be here to talk about the ABCs. I'm going to let Megs kick it off.
So when you hear ABCs of mortgages, this isn't just a basic lesson or your 101 course. This is actually breaking down the different types of lenders that we have available to us. So as brokers, we've talked in our previous discussions prior, we have the ability to look beyond just one set of solutions for clients to be able to find truly the right fit for a client's circumstances. So when we're talking about the ABCs, we're referring to A lenders, which would be your banks, treasury branches, credit unions, and some monoline lenders. Diana's going to dive a little bit more into that. Your B lenders, which is actually your alternative lenders, and then also C, which under the C category would be private lenders. So Diana, do you want to start us off on our A lenders?
Yes. Okay. So, we do actually often refer them to A lenders, B lenders, private, but ABC, it just makes so much sense when you visualize what kind of categories we have. So, I mean, A lenders, there's just so many ways you can get a mortgage, right? It's not just going to your banks. We, as mortgage brokers, we have access to banks, we have access to credit unions and monoline lenders. And these are all just A level lenders. That's the beauty of being and working with a mortgage broker. It's just like the vast array of options that we have, right? And so with that, what is an A lender? A lenders are top tier, like I said, banks, credit unions, monoline lenders. They have a strong set of guidelines that they like to stay in. We kind of sometimes use the analogy of like staying within that box. There's a little bit of movement in that, but they do have a strong set of guidelines. Typically, people out there, they'll say, what are the rates? We do have a great set of lower rates offered by these A lenders. And of course, they also have all sorts of different policies and guidelines, right? So the beautiful thing about the A space is that I would say majority of Canadians, home buyers would fall under that. And, these A lenders, they do have access to purchases, refinances, switches. This is kind of where we play in that space. And then we can provide so many options. So with every client, they have a different situation. And so it really depends on the type of person that we're talking to. So they want to, the A lenders typically want this ideal client, someone who has, strong income, qualified income that's claimed on paper. So you could be business for self, but you actually claim a higher income level on paper to qualify. Some typical great or clients that would fit in this box would be someone who has great credit, maybe a down payment saved, cleaner debt levels. You can have debt levels, but maybe a percentage that fits within the box. And that also fits within this income to debt ratio that we often talk about. We call it a TDS, a total debt servicing ratio. And this is where clients that fit into or under these A lenders, they have to show a certain amount of income, household income that we use for the application, and qualify to carry their debts that they have. It could be car payments, student loans, maybe credit card balances, along with the household debt, which is the mortgage payment, the heat, and the tax. And that has to fit under this so-called box under the A levels, but A lenders, I should say. So, but this is where A lenders we speak of all the time. Everyone's talking about rate or certain things, but the biggest key here is that we have so many. And so every situation is different. Every lender has different rules. Some might actually allow a higher percentage that we can push on that like TDS ratio that we were talking about. Some might have friendlier policies for newcomers, or even a person that had a past consumer proposal, versus if, let's say, one person went to a bank and they have a strict black and white set of guidelines and it doesn't fit. Well, we certainly can still stay under the A lender umbrella, but have a different lender that would give a more, I guess, what's that word? A more common sense lending approach. That's what I'm trying to get at. So that's our role. This is where it's exciting as a broker. We have so many. We filter out the policies. We compare their rates under all of the lenders that we have to choose from. And also, we understand that some customers have specific relationships with certain lenders or a past lender, or maybe they do bank at a certain bank that they really want to stay. Not a problem. We walk them through start to finish and really kind of can guide them and navigate through where do we choose and where do we pick. So that is kind of what our A lender box is when we talk to clients.
Yeah, those A lender clients are typically the most competitive rates. The advantages are the most competitive rates and pretty straightforward approvals. Where we come into a need for something beyond that is where we will look to our B lenders or alternative lenders. This truly is an alternative to lending that is created to have parameters that they still have guidelines, they still have policies in place, and they are still very well regulated, just the same as our banks or our monoline lenders would be. However, the investment funds that are used to fund these B lenders have a different threshold for risk. So when they analyze these mortgage applications, sometimes they're willing to make bigger exceptions than those A lenders we discussed earlier. We would use this in certain situations. Typically, and most historically, this would have been for someone who has bruised credit, so someone who's come across circumstances where their credit is a little bit bruised. However, now we more and more, especially with the state of our economy, we are seeing that there are other groups of people who would qualify under these programs as well. Things like someone who's got great credit, but their business for self and their debt ratios are just too high. So those debt ratios are either from circumstance or from trying to create opportunity for yourself, and you're carrying a little bit more debt than the average person in order to be able to make that possible. This is where an alternative lender is a really great option. Another situation is where you are relying a little bit more on contributory income. So contributory income is, say you have a family member who is staying within your home and they are helping to pay the mortgage. It's not necessarily a rental situation because you are cohabitating. However, the income from their assistance can help you qualify to be able to get into the appropriate property. Also in this category is a lot of new to Canada. New to Canada doesn't necessarily, there are really great new to Canada programs on the A side, but on the B side, if you don't have established credit within Canada, that's really difficult to allow you to be able to qualify on that A side. Within the B side, we can use other forms of alternative credit to help you get into a property sooner rather than waiting the required amount of time to be able to establish that. And then again, like Diana talked about, that business for self, where you, for tax purposes, have claimed significantly lower income than what your company is actually making you and what you're pulling from your company, and there is significant write-offs. In those circumstances, the alternative side is really, really great. Some of the things to note about the alternative side is it's considered short-term financing. It's not a long-term solution. It's typically a short-term solution so that we can re-evaluate your situation in 1 to 2 year terms to be able to adjust and get you into that A space where rates are a little bit more competitive. We can help you with building credit, working on budgeting, and consolidating debt in this space. This is a really great space for that. But again, in the end, you want to be able to refinance into that A space so that you can take advantage of the better rates. And when I say better rates, I really need to drive home the point that alternative rates are really great right now. That, like, historically they are higher than your A space, but we're still seeing alternative rates in that 5% mark. So even compared to some of the A space was 18 months ago, this is what we're seeing now in that alternative side. So it's a really great opportunity.
And I know we're going to use this word a little bit more going forward, but when I tack on to what you were saying on the B is a short-term kind of solution. It is our jobs, and we do have these hard conversations. We want to know what the exit plan is too. Whether it be that we have to be involved to help guide them to rebuild their credit, number one. Number two, perhaps they're in a business situation where they're looking to sell a business and money will be coming in a couple of years. So this is just a short-term solution. And also, perhaps they're coming into some sort of other form of money, or they're just happy to take it, and we're just going to be then guiding them back into that A space where we can lower the rate for them and kind of let them still continue building the equity in their home, really, right, by getting them in right now. And one last thing I want to add in the B space is because they're alternative, they're kind of like outside that box. I like to use that visual, and I know it's not always the case, but if there is, I mean, we've got B lenders that have 40-year amortizations, interest only payments, certain different types of income, as you mentioned, like so many varieties of different ways of adding income to the file to make those ratios, that total income to debt ratios, look good. And these B lenders actually allow a way higher threshold than like an A lender would. So just throwing this out there, but like on an A lender, typically our go-to number is 44% of the income to debt to stay qualified under the A lenders. But I mean, these B lenders, alternative lenders, they go anywhere from 50, 55, 60 on top of extending the amortization. So yes, it's not the go-to first solution for everyone, but it certainly can get that home buyer into a house to build equity. It can certainly help pay and consolidate their debt, alleviate the stress, bring down cash flow, perhaps even help them out of a consumer proposal, and just start their journey and have a reset. It's very important to have those conversations because that just goes so much further and deeper with like how we can help with clients and everyone's situation and what they're dealing with today. So,
Absolutely. The real advantage of using an alternative lender, or as we get into the C portion of it, private lending, is that it can be a bridge for the time frame that you need it in for that moment. And then we work on a plan with you to be able to transition things onto the A side as time goes on. So this is just kind of a snapshot for the moment where these are solutions that we can use to help expedite that process rather than starting the work and trying to get there exclusively with time. These are some of the tools that we can help you with to get there. On that note, we'll lead into private lending. So C is just the natural ABC. However, the other bucket of lending there is private funds. Private funds are very specific to the situation. These are situations where there's usually major life changes, or a client might be in really great situation, but they need money urgently in order to be able to execute something, whether it's a business opportunity or a move or a family circumstance with aging parents, those types of things. That's where private funds are really, really useful. Typically, the qualification is a little less stringent in terms of the documentation that's required, and also the income that is required to be able to help you qualify. These solutions are created to have really flexible payment plans, to be able to either have interest-only payments, or in some cases, your interest payments are included in the equity takeout from a refinance, so there's no active payments during that term. But again, these are really, really short-term solutions to be able to provide an opportunity for that moment.
Mhm.
Diana, did you want to add to
Yeah,
that?
I want to share a quick example of a client that we're helping with right now. It's, again, when we talk to so many clients, you just really can dive in and understand that so many people are going through their own thing, and they just really need this like trusted, confidential conversation with somebody to guide them or give them options. And I feel like that goes so far. So this client, unfortunately has had quite a bit of debt accruing over the years. And I'm bringing this up because it is not the first conversation I've had this month, this year. It is just more and more of people, accruing some debt. So what happens is that months could go by and now the creditors are knocking at the door and they need some sort of payment. But the client is either circumstantial, right? Could be laid off, have low income, have to deal with something in the family, and is doing their best. They really do, but they do not want to foreclose. Their intention is that they are and planning on selling in the spring. They need time to get this house ready. They're working with real estate agents. They've got a plan in action. And again, we will allude to this exit plan. That is the exit plan. The lenders want to hear this. And so, luckily enough, prices are going up in Edmonton. So the appraised value came in really well. He did buy this place 15 years ago. So he's got plenty of equity there. And, he needed like 80 grand, $80,000. It wasn't like a crazy amount, but it does help him get the stress off his back. We can kind of consolidate, have a plan in action. But the reality is that the exit plan is he is working to list his place in the spring. So like that's just like a classic example that they need help. They're now they've probably waited so long because they probably could have called a couple of months ago, but no problem. We got it done. Appraisal was done very quickly. Funds are transferred pretty quickly, and off they go. So now we're just going into the next stage. So that's like a very classic short-term solution, but it happens all the time. And people need to know that there are options there. And we look at the equity. Equity position, location position on a property is very important. Um, we don't really look at income on these situations. They really look at the property as what the risk assessment is on that property.
Yeah.
So best thing is to give a call.
Absolutely. And so, regardless of what situation your client or yourself is in, we really need to drive home the point that working with a mortgage broker has its advantages. We are extremely dedicated to trying to find the best possible solution, whether it's in any of these A, B, or C buckets, to be able to um, find the potential and proceed through. And sometimes that means we go to an A lender and there is a decline there for whatever reason. Then we have these other alternatives and we don't kind of give up at that one stop.
Mhm. Yeah. Yeah. So it's kind of nice that we have all of these options. Um, I would never want someone to just go into a bank, to be honest, and have one conversation, maybe get the right advice or the wrong advice, we don't know, but also that feeling of being deflated or like I need some help, who do I ask? And so it's really important for us to share the knowledge and share that we are here for conversations wholeheartedly. The best interest of the client comes first, top priority.
Always. Yeah.
Mhm.
Yeah, and just on that point, when you're talking about going into a financial institution, not too many people don't realize that the person that you're speaking to at your financial institution isn't actually licensed by the governing body that regulates mortgages in the province of Alberta. So if you're wanting to go to someone that actually has some skin in the game and some education and some better regulatory behind them to make sure that it is more ethical and better suited for the consumer, then 100% a mortgage broker and someone at the mortgage minds like Diana Lee or Megan Wendell would be fantastic choices for you.
Thanks. I want to add one last thing before we end this is, we did allude to and we talked a lot about business for self, right? And so business for self is just a topic that I want to kind of put out here that we'll probably bring up next meeting because
Mhm.
business for self can really fall perfectly into A, but I might have to go into an A minus or a B, or it might go into private. And so often when I'm just going to pick on you, Alex, like, when you're talking to your clients and your homeowners, you're getting to know them. You get to know about their life, what business do they have. You get excited about their next journey. But those type of conversations might come up and be like, oh, you know what? This is best suited for a broker because we don't know where they will land. Um, yeah, it's all about that income and kind of how they claim and where they fall under.
Yeah,
So,
the greatest thing about being able to go to someone like yourselves is there is a lender out there for everybody.
mhm,
It's just finding the right lender. And if you go to a spot where there only is one lender, one box, you might get discouraged because you might be a great applicant for lender B, but lender A that you're going to is just you're not. And that's okay because they're the ones giving out the money. It's their right on how they who they give it to, but everyone chooses differently on what their risk tolerance is. So that's a great point, Diana.
yeah,
And it explains that there's so much choice out there. Being a layman like myself, it's overwhelming. That's why we need professionals. And so, yeah, start that conversation early, both with yourself and your clients. If you're a home buyer or homeowner, if you're a homeowner, the chances are you have a mortgage. If you're a home buyer, chances are you will have a mortgage. So, getting those conversations started early is impeccably important to ensure that you have a smooth process in your journey.
you bet.
But I talk a lot and I talk fast, so I'm going to also say that you need to hit that like and subscribe button so that you don't miss a single miss of or miss a single moment of our next Mortgage Minute with the Mortgage Minds, which is going to be happening in 2 weeks from today. So stay tuned. And Diana was already kind of chatting about it. It's going to be business for self, and that is a huge thing because Alberta is the entrepreneurial hub of Canada. So there's a lot of you out there that could definitely benefit from this information. So stay tuned and we will see you guys later. Bye, everyone.
Bye, guys.